Good morning, everyone, and thank you for joining us for our 37th annual Perryman Economic Outlook. Although we're going virtual this year, we'll still have a first-hand update from our good friend, Dr. Ray Perryman, on the economic outlook for the U.S., Texas, and the San Antonio, New Braunfels area. But first, today's webinar would not be possible without the support of our sponsors. Thank you to our title sponsor, Amagi Bank, our virtual event sponsor, Pape Dawson Engineers, our Chairman's Council sponsors, Brooks, CPS Energy, Frost, Northwest Loop 410, Principal BMW of San Antonio, SWBC, Valero, Wells Fargo, and Zachary Corporation. Thank you all so much for your continued support. At this time, to introduce our title sponsor and today's moderator, I'm going to turn it over to Trey Dawson, who is a Senior Vice President at Pape Dawson Engineers and our 2021 Chair-elect for the North San Antonio Chamber. Trey?
Good morning, ladies and gentlemen. Thank you, Christina, and welcome to the North San Antonio Chamber's 37th Annual Economic Outlook. I am Trey Dawson, Senior Vice President for Pape Dawson Engineers and the Chair-elect for the North San Antonio Chamber. I am pleased to be here with you for what is not only one of the most popular events of the year, but it is an exceptionally important one after this trying year. I would like to thank David McGee, President and CEO of Amagi Bank, and our moderator for this morning, for making this event possible year after year. David, we appreciate the support and are looking forward to your conversation with Dr. Perryman. One small housekeeping item to mention: if you have questions along the way, please enter them in the chat feature of the webinar so that David and Dr. Perryman can get to them at the end of the presentation. I will now hand it over to our host, David McGee.
Well, good morning. Thank you, Trey. Appreciate it very, very much. And I know it's just so great to be here today, to be alive, to be engaged, and I hope all of you are doing very, very well. I'm sure you feel that you share my thoughts. I have been in my career to, I don't even know how many chamber breakfasts and dinners, probably 4 million of them, but I have to tell you, I miss them. And these video calls are really great, and I appreciate the North Chamber putting this on today. But I'm really looking forward to when we can be back together again and shake hands and just check in with each other. So I hope you all are doing well, but anyway, looking forward to being back together again as soon as we can. Trey, congratulations to you and your selection as chair for the North Chamber for next year. You and your family have done so many great things for our community, and it's just awesome to see you picking up the mantle of leadership, and we're all expecting really great things under your leadership next year, not the least of which will be to get us out of the year of the plague under David Pope, our current chair. And anyway, all kidding aside, David has done an awesome job, and nobody's really laid it on the line more than my good friend and fellow banker, David Pope. David, thank you for muscling through, and we're glad to know that you're doing well and doing a great job. Speaking of fellow bankers, I want to give a shout out to all the bankers that are on this call this morning. What you all may not know is that when the first round of PPP was being contemplated, when Congress was actually working on the law, your local banks in this community were all collectively talking about how they could help each other and help the business community access this stimulus money. We were having calls about twice a week. And all of the banks that are sponsors of this event and members of this community, and I won't mention them all, but they know who they are, they were collectively getting together trying to understand how people could get through this program. And that's remarkable because typically the banking community is pretty competitive, and to see the collaborative effort was pretty rewarding. But at the end of the day, what we had was the banks came together and put together a program in 8 weeks. In 8 weeks, the banking community across this country actually funded loans that would have been the equivalent of the 7th largest bank in the country in 8 weeks. Now think about it. We were all working remotely, probably for the first time in our careers. We created a product that didn't exist 8 weeks earlier. Had to create end-to-end platforms to launch this and make it available to the business community. And anyway, all that happened in an 8-week period, and it ended up being a huge benefit. I know many of you are today working through the forgiveness phase of that, and it's been clunky. We know that, and we'll continue to work through all that. But I want to just give a shout out to the local banking community for all the great work that they've done and they're continuing to do. So what happened with the PPP program is just on a long list of things that are, things that we never thought would happen in our careers, and there's a lot of things happening in the economy today. Usually, when Dr. Perryman comes, we're going to hear a bit of an update on the oil and gas industry, maybe workforce, what's happening in global trade. But what we're dealing with today is a list of things that we just never thought would happen, the PPP program being one of those. And there's nobody better than Dr. Perryman to really kind of pull these complicated things together. I first met him when I was a student back at Baylor in the 80s. I was actually in his first wife's class, and she did a great job of confusing us all for most of the semester, and occasionally he would rescue us and come in and substitute teach in this class, and he had an amazing gift of being able to take complicated matters, pull it together, and help even someone like me understand what was happening. I don't know whether you all realize this. If you're listening to this for the first time, Dr. Perryman's doing this, has been doing this economic update for San Antonio for 37 years. And he certainly understands what's happening in Texas and the national scene, but also taking personal attention, really close attention to what's happening in San Antonio. I probably wouldn't be in banking today if it hadn't been for Dr. Perryman. He's the kind of guy that really takes a personal interest in people and also what's happening. I also don't know if you realize that he's been in some form or fashion, an economic advisor to every administration back to Jimmy Carter, and certainly to every governor between then and now as well. Yeah. And so absolutely have the right person here this morning to kind of help us get through the fog of the stimulus program, what's happening with China, a new administration, and new monetary and fiscal policies that may be coming our way, and how that might impact the energy industry in San Antonio. But there's really not a better person than Dr. Perryman to help us kind of understand the future. So, Ray, it's really great to have you here this morning. Thank you again for being here, and I'm going to turn it over to you.
Okay. Thanks, David. I appreciate it very much. It's good to be with you. I, like David, wish we could be in person. This has been a very, very strange year for me. To give you a little bit of perspective on my year, in a typical year, I'm on the road about 300 days, give or take, plus or minus a few. This year I've been at home about that many days. And so not only has my understanding bride had to learn to deal with me being home all the time, but also the world I bring with me kind of taking place over cameras and remotely there at the house. And one day I remember I'm not sure what all was going on, but she was really, I think I just about pushed her to the limit. And I said to her, well, Lorraine, really, I'm kind of like bad tasting medicine. I'm better in small doses. And she thought about it for a minute, and she said, that's really not true, because eventually bad tasting medicine makes you feel better. And so that's kind of what my year's been like. But we've gotten through it, as you all have. There's been a lot of challenges. I hope everyone is safe and well and continuing to take precautions. I'm going to try to take a few minutes here and just put a big picture perspective on this, as well as talk about some of the local area things that are important, and try to give you some sense of the craziness that's been going on here, and maybe help you kind of see how things might look on the other side. I will tell you, I have been doing this since, as David mentioned, I did my first forecast. We actually started building the Texas model in the late 70s, released the first forecast in January of 1982. So basically, I started out in an oil boom, did my first forecast in an oil bust, went through the savings and loan crisis, the dot-com crisis, the accounting crisis, the Y2K crisis, the mortgage crisis, and we've never seen anything like this, nothing remotely like this in terms of the amount of uncertainty we're facing and the things we have to deal with. So the first thing I would say about this one, of course, is it's not surprising, it's atypical. Almost every recession we have is because of something that went wrong in the structure of the economy, usually something we brought on ourselves, being too aggressive in mortgage lending. would be an example. Being too aggressive in real estate syndications, being too aggressive in dot-com stocks. It's usually some type of speculative bubble we create ourselves that ultimately bursts. So you have a structural problem to fix. This time around, when this hit us, we were in the 11th year of an economic expansion, the longest in U.S. history. And it still has some legs. I mean, the economy's never perfect, but there wasn't anything big that was broken. So at first, the small amount of cautious optimism I had about this was the fact that we didn't have to go fix something. They didn't have to appoint a task force and bring a bunch of us together to try to fix something. This was an economic crisis that was brought on by a health crisis. So if you could deal with the health crisis, then the economic crisis would take care of itself. We didn't have to go do something, pass laws or jiggle it around a lot. And at first, I have to tell you, it was fairly encouraging to see what happened. The first thing I would mention, though, is we have never seen the economy fall this far, this fast. We've never seen that in our history. If you go back to the 2008 recession, which was the worst since the Great Depression, the United States lost 9.4 million jobs over 14 months. This time we lost 23 million jobs in 2 months. I mean, you can't even get your arms around how hard this thing hit because we basically shut the world down. I mean, the demand for oil dropped almost 30% in 1 month. Now think about it, in the entire world. The demand for oil dropped almost 30%. That only happens when you start shutting things down across the entire globe, and that's what we did. The GDP, they report in a weird way, they annualized the quarterly number, had a 30% drop one quarter, 30+%. It's actually about 8 or 9%, but still, we'd never seen anything like that. We never saw a quarter drop more than 1 or 2% unannualized, 5% annualized during the Great Recession. I mean, this was something we hadn't experienced before. The initial claims for unemployment, the weekly number that we all used to pay no attention to that we now obsess on, the highest number we had ever seen was 695,000. That was back in the Great Recession. We got to 6.9 million. And 35, 38 weeks in, we were still above 700,000. We hadn't gotten back to the worst week we'd ever seen before in that period of time. And I say all those things simply to say this is something that we haven't seen before. And then we start the comeback. And initially everyone said it's going to be a V. I didn't say that. I never thought it would be a V because it's literally physically not possible to come back as fast as we went down. And we're seeing that now. We've certainly had a decent comeback, but we lost 23 million jobs in 2 months. In the ensuing 6 months, we've gotten back a little over half of those. So it's a nice steep recovery. It looks pretty good on the whole, but it's certainly not a V. It's certainly not going to come back as fast as it went down, and that never was possible. Several things helped us initially. One was David mentioned the CARES Act, the PPP program, things like that. People got behind this and immediately began to do some things to respond, which is what we needed to do. And it certainly wasn't perfect. Some folks got some money that shouldn't have. Some checks went to dead people. As David said, it took them forever to get the rules straight on the PPP. But it did get much needed funds in the hands of individuals who were suffering through no fault of their own, businesses, and particularly small businesses, major industries like the airlines that were suffering. So it did some things to keep the structure together. And that's as I keep saying, and you'll hear me say this over and over again, keep the structure together, we can come back from this pretty quickly once we get the virus under control. And the Federal Reserve, behind the scenes, was literally pumping trillions of dollars into the economy. Every way you can imagine, government securities like they usually do, mortgage-backed securities. They even bought some PPP loans so the banks would still have liquidity to make other loans. Small business direct lending. I mean, the Fed started doing things it normally doesn't do just to keep that structure together. So we started off in a pretty encouraging way, all things considered. It has slowed down some since then. We are in a recovery. It has come back a lot, but we have a ways to go. In terms of forecast numbers, the documents you normally get when you come to the breakfast that we produce every year, we provided that to the chamber, and I'm sure they have a mechanism to get that to you, and you'll be able to look at it. But we have all those numbers out there. I just want to focus on a few. As I mentioned, the U.S. economy at its peak was down 23 million jobs, or at its trough. We think at the end of the year it'll be down about 8 million jobs from year over year 2020 versus 2019. We think it'll be down about 8 million jobs. So that's a lot of comeback. we've gotten back a lot of this, but we still have a way to go. We're not going to be back to where we were before. We think we're going to lose probably $680 to $700 billion in gross product this year on a base of about $20 billion. So again, about a 3.5–4% drop in gross product. That's, given where we started, that's not a bad place to end up, but it's still significantly behind where we were. We still have a ways to go with this. We're forecasting growth over the next 5 years for the U.S. economy. About 3.8%. That's a little faster than normal. We've been growing around 2.5% to 3% for a long time, but part of that's catching up, the regaining. We've already gotten back a lot of the low-hanging fruit. The recovery started very quickly, and you would expect that. People were laid off from restaurants, retail outlets, that sort of thing. They get to reopen a little bit, they get rehired. And so you expect that. We had those months where we got 3 or 4 million jobs back in a single month. We're not in that mode at this point in time. Part of that's, again, the low-hanging fruit came back pretty quickly. Another part of it is that, frankly, this has just lingered a lot longer than we thought it would. And we really need a new package to take place right now. I know the politics, the election's been strange. I'll say a little bit about that in a minute. But the election has brought on the worst of politics in some ways, as both sides have kind of gone to their corners. But we really need to come together and get something done. There's a proposal out there now that's a compromise proposal that's getting some traction. Frankly, it's about a third the size it needs to be, because the problem was the CARES Act was very good, but it sort of assumed we'd be displaced for 2 or 3 months, and then things would get more or less back to normal. I mean, not exactly, but we'd be kind of rocking and rolling, everything would be open again, and that sort of thing. We're now 8 or 9 months into this, and consequently, even a very well-run small business that's had a 50% revenue drop for 8 months is going to be in trouble. Even a very well-run household that's put up savings and all the things you should do, if they go 7 or 8 months with no income or low income or much less income, their liquidity is going to be exhausted. And so we find ourselves in that situation right now. And the problem, as I said at the beginning, we need to keep the structure together. We're in great danger of breaking it right now. It wasn't broken when we started this. We don't need to break it in the middle of it. Hopefully, again, we're doing a lot of conversations. There's a lot of back and forth and talking going on. Hopefully something at least can come together, and then maybe get more done in the new year. We'll see about that. As far as Texas is concerned, most of the time, almost every time we've ever had a recession in the U.S., I've been able to come in and say, yeah, it didn't hit Texas nearly as hard. We kind of dodged this one. We're coming back a lot faster. It's really not true this time for a couple of reasons. Number one, obviously I mentioned oil. I mean, literally one day the price of oil went negative. I told some of my clients 2 or 3 weeks before that could happen on that day, because it was a weird combination of so much being produced, so little being consumed, no place to store it, and that was a delivery date for major contracts. So if you owned the oil that day, you had to do something with it. And so you got to the point people were literally paying people to take it off their hands. That was a temporary phenomenon. But oil prices went very, very low for a fairly long time. They're back now up a little bit into the low 40s, $1 per barrel range most days, and that's enough to get some production in Texas. There's some parts of the state where that makes sense, but it needs to be a little bit higher. 7 or 8 years ago, when the Eagle Ford was first raging, and everybody in San Antonio was excited about oil and gas, you needed a price of about $60 or $70 a barrel to make it remotely make sense. Really, you need about 75. Today, somewhere around 50 or a little less will get you there, because of all the improvements in technology and the cost structures and that sort of thing. And again, I'll focus on that in just a few minutes going forward. But there's a few other things I want to hit on first. San Antonio, Texas. I guess to fill it out, I think we'll be down about 550,000 jobs at the end of the year. We were down 1.3 million at the trough, so we made some progress. In addition to the oil situation in Texas, we're the #1 exporting state in the country, and obviously shipping stopped for a while for all practical purposes. That had an impact on Texas. And our friends to the south, which are so important to the San Antonio economy, in Mexico, have had a really rough time with this. We're going to end up the year down roughly 4% in GDP. They're going to end up roughly 12% down in GDP. And that feeds into Texas, because we're very heavily integrated with Mexico. So we have a lot of challenges here. Having said that, we've still done a little better than average. We've done fairly well, but we still have some challenges ahead of us. we think growth the next couple of years is going to be somewhere in the 4.4% range, or the next 4 or 5 years, something like that, which is again a little above where we've averaged, but part of that's making up the losses that we're experiencing here, and it's going to take us a year or so to do that. San Antonio, obviously, in addition to the proximity to Mexico, San Antonio is a major tourism town. It is a major town for people who come into San Antonio, major conventions, those kinds of things. So that was one of the big hits that San Antonio took. And it's kind of every city had something that was a little worse than average, and other things where they did a little better than average. San Antonio's manufacturing has done particularly well compared to other areas. So, but even with some significant gains in the last 2 or 3 months, the hospitality side is still down quite a bit. We think you'll end up a year down about 45,000 jobs year over year from last year. You started out at the worst of it, well above 100,000 jobs down. So again, made up quite a bit of it. Still have a ways to go. We think the growth rate over the next 4 or 5 years is going to be like 4.8%, significantly higher than Texas and significantly higher than the United States. A lot of good things going on here. David mentioned the work the banks have done. You've had some significant new locations even in the midst of this, some significant real estate development even in the midst of this, and you recently passed some issues that will allow some workforce spending and workforce training that I think will pay tremendous dividends for decades to come. And I think to vote to do that in the middle of a pandemic is a real testament to the strength of the city. So like I say, there's a lot of numbers in there. I don't want to dwell on the numbers right now because there's so much to talk about. But let's look at the future and see what it's going to look like as best we can beyond the immediate pandemic, and hopefully with a combination of vaccines and therapeutics and behavior changes, we'll get to our new normal fairly soon. And learn to peacefully coexist with this virus like we do with the flu and other things. There's going to be a lot of things changed. There's no question. Strangely enough, we're just starting to put together our long-term forecast. I think we're going to release it in January. And the numbers I'm looking at now, if you look at 20, 25 years, the numbers don't look that much different in terms of the overall total. The composition has changed quite a bit. But as far as the economic potential, it's still there. And I'll speak to that a little bit more in just a moment. But first, I want to focus on some things that we know are going to change. And I think some of them, frankly, can benefit San Antonio pretty significantly. But one of them is the real estate industry is going to change. Lots of folks are working from home right now. As we get back to more of a normal situation, more of those people are going to come back to the office because there's just advantages to being face-to-face, working with people, collaborating with people, and that sort of thing. As much effort as the chambers put into where we are today, it'd be better if we were all in the same room chatting with each other. We'd all love that a lot better if we could do that. And that's just the nature of business. It's how things get done. But I think there will be more work from home. On the other hand, we're going to have to revamp what the office looks like. And so I think that the real estate industry is going to have a kind of two competing forces here. Probably fewer people on an average day working in offices, but each person requiring more square footage. Because we're going to have to focus on that. And historically, when I first started building these models back when David and I both had hair, or at least I had hair and his was dark. When we first started doing this back in the day, when you were modeling real estate absorption, every time you added an employee to an office, you added about 350 square feet of needed office space. We've gotten that number down to about 150 through the way we have become more efficient in the use of space over the years. That number's going to start creeping back up. And so I think that there's going to be those things kind of competing with each other. Retail is going to be different. There's no question. We're seeing that in the Christmas season right now. We've seen it throughout the year. They had half as many people in the stores on Black Friday as they did last year, but on Friday and Monday, online sales set all-time records. And we're going to see, I think, more of that. There was already a trend for the last 15 years. Every year there was a little bit larger percentage of retail sales came online. This put it on steroids because it compelled a lot of people to shop remotely. And so we had that situation going on. And that was a very important piece of what happened in the midst of this. Once we're through it, again, I think a lot of people want to go back to the stores. People like to see, feel, and touch things. People like to talk to salespeople and get information about things. People like to do that. There's advantages to that. Retailers will respond to that the way they always do in a market economy. They'll adapt their locations to make that attractive to people again. We see this all the time. You know, a number of years ago, when I first started doing this, every town no matter what size, wanted a big, huge indoor mall. Today, everybody wants a nice outdoor walking mall. That happened before the pandemic. There will be different ways that retailers come up with, and markets will adapt. They'll promote their online sales more, but they'll still accommodate in-person sales. So there's so many interesting. One thing I'd like to focus on. I mean, you can't talk about all of them, but I think what I know is important to the chamber here and important to this town, given your track record, your commitments, and that's economic development. Because I think it's going to go through some fundamental changes now that we haven't seen before. First of all, there's going to be a lot of new opportunities, and that's because of a number of things. First one is the major one is something that people are calling reshoring or onshoring or something like that. The notion of manufacturing industries coming back to the United States. About 50 years ago, actually in September of 1970. An economist, I was still in high school at the time, but an economist that I later got to know quite well later in his life, Milton Friedman, who was very influential, wrote an editorial in the Wall Street Journal that really changed the whole focus. It really changed the focus of how people, I think it was New York Times he wrote it, changed the focus of how people thought about things. And the title of it was, "The Social Responsibility of Business is to Increase Its Profits." And that notion caught on, and we went through a number of years where minimizing cost and maximizing short-term shareholder value became the guiding principle of American business. We did it for a long time. That's been changing for quite a while. Last year, well before the pandemic, the Business Roundtable, which is the largest business in the country, led by a good banker named Jamie Dimon, put together a statement saying that in the future they're going to focus on the so-called ESG movement, that is environmental and social governance. It doesn't say you don't try to make profit, but it says you look at sustainability and you look at resiliency and you say, what does my community need to look like, my workers, what do I need to do besides just go for the low bidder? Then along comes a pandemic and it puts a whole new spin on that and once again puts it on steroids, because if all you're trying to do is get the lowest cost and you get the lowest bid happens to be from China, you buy all your stuff from China. If you suddenly are faced with a situation where you China gets shut down and you can't get your parts in, the first evidence we had of this pandemic was a supply chain disruption. Before it ever came to our shores, Chinese goods couldn't get to the United States. Practically every company in the United States had to have them for inputs to manufacturing. So we would have had a recession if this thing had never gotten to the United States. Much milder, but we would have had a downturn because our supply chain was broken. And so people are saying, yeah, we'll still buy some from the low bidder. We're going to make sure we have enough here that we can produce that we can continue to operate. And so they're looking at bringing a lot of manufacturing back to the United States. And also, beyond that, a lot of the critical manufacturing. I think a lot of people were shocked at what percentage of our medical-related manufacturing came from other places. Those kinds of things that are critical, and a focus on sustainability and resiliency, which you can view in a different way if you want to take the sort of traditional business view. Just look at maximizing profits and shareholder value over a little bit longer time frame, because that's what you're doing if you're supporting resiliency and that sort of thing. So that brings a whole new dimension to the to economic development. Since there's going to be a lot of companies coming back. And the United States will get a lot of those companies. Mexico will get some of them. A lot of it, I think, can benefit this part of the country. The other things happening in economic development that we're already seeing is a real focus on some things that have always been on the checklist. If you go down, there's always a checklist. Do you have good schools? Check. Do you have good healthcare system? Check. But they're somewhere down in that bottom part of the list, not the things that drive a location. Now people want to know, number one, you have a good school system that if it has to work remotely, it can. You have a good higher education system, and if it has to function remotely, it can. You have a health system that can deliver what's needed, and you've certainly been challenged and met that challenge here. And for many years, that's been a strength of San Antonio. Broadband access. What does that look like? If I have to work remotely for months and months and months, can I do that in this community? Those kinds of things, and workforce. Having a workforce that's adaptable and able to learn new things and do new things, those things are going to become even more critical than they have been in the past. And they will be the deciding factor in many locations. Very few companies today will look at a place if they think, wow, if something happens, they're not going to be able to take care of my people. I mean, they're not coming. I mean, it's pretty much that simple. And so the whole dynamic of economic development has changed. And these are a lot of areas where San Antonio has some strength. Move out a little longer term than that even. Let me do this. And I'm getting close to wrapping up and getting to the point that we can have a conversation and take some questions and that sort of thing. If you don't ask me anything, I'll just keep talking about something else. But anyway, a couple of thoughts. Let's go beyond that to the very long term. I get a lot of questions. What's this election going to do to us or for us or whatever? The answer is, in all honesty, probably not very much. I think there are a couple of areas where it can be beneficial, and there are some policy areas that may be not quite so beneficial. But if you look through history, presidential elections and who's in the White House has had very, very little impact on the economy. We've studied it, lots of other folks have studied it, and the consensus is that performance has been a little bit better in Democratic administrations. If you think about that for just a few moments here, the Johnson administration had a strong economy, the Clinton administration had a strong economy, the Obama administration had a strong economy, so it's not surprising you would find that, but it's not a very big difference. It is statistically significant, which means it's not random. It's outside the margin of error, so to speak, in the recent terminology we've had to deal with. But it hadn't been a huge number, and you can't necessarily say it's causal. It's because you had a Democratic president, because that may well be because of policies put in place before they got there, or just circumstances that happen in the world, technology changes, there's all sorts of things. But the bottom line is it has made very little difference. I think there are a couple of areas where we might see some benefit here. One of them is that we are hopefully on the cusp of vaccines and therapeutics that will let us begin to really get this thing under control over the next few months. And I think that particularly with the Biden administration picking Ron Klain as chief of staff, he has experience with this sort of thing and understands it. I think there'll be a real focus on what do we need to do to get this out there. I mean, the military is already engaged. I think it would probably go pretty well one way or the other, but you'll have someone in charge of it who really has been there before, and I think that's a beneficial situation. And then the other one is the one thing above all else that economies and markets hate is uncertainty. Good news, obviously that's the thing we like the best. Bad news, don't particularly like it, but you can process it and price it. And that's all markets need. As long as they can price something, they'll figure it out and move forward. Uncertainty is difficult. I tell people back early in April and May, when the stock market would sometimes go up or down 2,000 points in a single day, sometimes up and down 2,000 points in a single day. The problem was, normally, markets work because different people have different risk-return profiles. They have information out there. They evaluate it, some buy and some sell, and when you do that trillions of dollars every day, that makes a lot of markets. All of a sudden, they couldn't see the curves to make the trade-offs. And so when that happens, it becomes sort of chaotic. The more information we've gotten, the more stable the markets have been. I still wouldn't call them stable, but we're not seeing those 2,000-point swings anymore. Markets, and we've seen it over and over again throughout history, markets don't like uncertainty. And that's why the overall economy didn't react too much to the accounting crisis, the so-called Enron crisis back in the day, but the markets reacted a lot. And the reason was that got to the core of what they do. They process the information in those financial statements. If they had questions about the financial statements, then that caused a whole wave of uncertainty. That's what we've been seeing. In general, whether you like or don't like the policies of the current administration, they have tended to be inconsistent and not always, there's had to be a lot of backtracking, reversing, and not always well thought out in advance. I think we'll have a more traditional situation now, and I think, and that's likely to create a little more certainty for the market, so they can price things a little better. Because when we're uncertain, we tend to go to the sidelines, and that's the last thing we need in this economy, is to have anybody on the sidelines. So I think there's a little bit of benefit there. Policy-wise, I don't think the major aspects of the Biden agenda from the campaign are probably going to be enacted. There's a lot of things that were talked about. Daniel Patrick Moynihan once famously said that we campaign in poetry and govern in prose, and I think there's a lot of truth to that, given the makeup of the political situation right now and the divisiveness. I don't think there's any major initiatives that are going to take place. We don't know what's going to happen with the Senate yet. There is a scenario in which the Democrats have the House, the Senate, and the White House. But even that doesn't guarantee you for a couple of reasons. Number one, it takes 60 votes to do most things in the Senate. and neither side's going to have close to 60 votes. So a lot of the major initiatives can't happen under that environment. And also, if you take a 50-50 Democratic scenario with the vice president breaking the ties, if both Senate seats in Georgia went to the Democrats, there's a huge gulf between Joe Manchin in West Virginia and Elizabeth Warren in Massachusetts. I mean, there's an enormous gulf in their philosophies and what their constituents want and that sort of thing. And you can only have one defector. So I mean, even under that scenario, I don't see a situation where massive new programs get enacted. I think we're going to have more muddling through in Washington, and that may or may not be a good thing. But all that to say, elections don't really drive the economy that much. We get all exercised about them, but they don't really drive the economy that much. The things that drive economies over a period of time are demographic shifts, changes in technology and innovation, and trade patterns and cost patterns around the world. We've put a pause on some of that recently, but we haven't changed any of it. World demographics haven't changed. Technology, if anything, we've created new incentives to create new technologies because people are going to figure out ways we can get together again. People are going to figure out things about healthcare that on a more accelerated path. I mean, we just created a lot of market incentives to accelerate technology, and trade patterns and cost patterns. They haven't shifted much. So basically, all those big things that drive the economy haven't changed. And so, yes, we have to go through this. It's been a horrible situation. It puts a big pause on things. But it's not something that is one of those things that once you come through it and figure out what the new normal looks like, then we'll move forward and we'll grow and we'll prosper using the same factors we did before. Some people say, well, what about all these things that are different? We adapt to those things. Think back to 9/11 for a moment. Nowhere near as many people involved in as massive readjustments. But before that, we could go to the airport 45 minutes early. If you want to take 10 members of the family up to the gate to meet grandma, you could do that. It wasn't a problem. We changed a whole lot of things after 9/11, things we didn't think about before. And yet the economy kept right on rocking and rolling. And that's what it's resilient. It's built on innovation. And what you do in those situations is you incentivize innovation. In 9/11, we incentivized innovations in the area of security. Now we've incentivized in the way of healthcare and congregating and being able to function and do the things that we need to do going forward. We've incentivized people to solve those problems, and they will. That brings me to just a few comments about oil and gas, because David mentioned that. I know it's important to this area. It's important to a lot of Texas. If you look at the future of the world economy and just look at the growth and post-pandemic, next 25 or 30 years, most of it is occurring in the emerging countries of the world. It's not happening in the United States. It's not happening in Western Europe. It's not happening in Japan. It's happening in that other half of the economic world, because roughly those areas make up 50%. These other areas are now going through their industrial revolutions. They're manufacturing things and making things. And what that means is when they grow, they need more energy. That when we grow, we grow into more energy efficient buildings and more energy efficient cars and more service sector jobs. We can grow a lot without using a lot more energy. Those countries are in the energy intensive phase. So whatever you see the growth rate in world GDP to be, 75% of that growth is coming from areas of the world that are energy intensive and becoming more energy intensive, and that's very important. What it says somewhere between 25 and 30 years from today, I probably have changed my number from 26 to 27 based on the pandemic, but somewhere between 25 and 30 years from today, the world's going to need twice as much energy as we need today. Think about that. All the energy we use in the world today, we're going to need that much more. We're going to get a lot of it from renewable energy, from wind, from solar, from water. We should. We need to. We're going to get a lot of it from, we may bring back nukes and figure out ways to do that safely. We're going to figure out better ways of storage, the lithium-ion batteries and the other battery techniques, hydrogen as a storage mechanism for energy. There's things like that. We'll probably have a black swan or two. We'll have some new things come along that we hadn't even thought about before. That'll change it as much as the iPhone changed our lives 10 or 12 years ago. We'll have those. Maybe let's have a revolution in there too, just for good measure. If all of that happens, we're going to get 60 to 70% of our energy from hydrocarbons in 30 years. Now, what that says is, and there's one law of economics I've always found to be true, And I was too young. I didn't know it yet when I taught David. But after going through everything else, I found out economics really laws are kind of flexible. They're more like maybe city ordinances or something. But the one law I found to be true is if something has to happen, it will. Markets create incentives, and that causes things to happen. Now, what that says is this election, as I say, the campaigning in poetry brings us to let's ban all oil and gas. Climate change is a hoax. You heard both of those things during the election. They're both ridiculous. We're clearly seeing major impacts in the climate, and we're clearly going to need hydrocarbons. The kind of obvious solution to that is let's burn the hydrocarbons cleaner. Let's not let all that carbon get into the atmosphere. And the energy industry knows this and is investing billions of dollars in doing it right now. So we will be using oil and gas. And because of the cost structures, the quantities, the pipeline structures, the shipping capabilities, a lot of that energy is going to come from the state of Texas. And we're going to be a very important part of the world energy environment for many years to come, particularly now that we can liquefy and ship natural gas around the world and those kinds of things. So again, so I wanted to kind of just bring that focus in and try to get you to kind of look at the big pictures beyond this. And it's hard to do in the middle of this. I know it is. And I think that's the final thing I want to talk about for just a couple of minutes. Whenever we're in the middle of something, it's sometimes hard to see what it's going to look like on the other side. And we tend to extrapolate today perpetually. And there's a long history of this. There was a very prominent preacher who was also an economist back in the early 1800s named Thomas Robert Malthus that had a theory that some of you probably heard of, that food supply is going to grow basically arithmetically, and the population is going to grow geometrically, so we're all going to starve. That didn't happen because we figured out how to make agriculture more productive. I can give you a much more recent example. In Austin, Texas, 1990, in the middle of the real estate bust, there was a headline in the Austin paper that said Austin has a 25-year supply of commercial real estate in 1990. If that had been true, they wouldn't have built anything in Austin until 2015. I think we all know that they built a little bit. Your traffic's gone up a lot because of the stuff that's been built since then. In 1993, 3 years later, what was the number one commercial real estate market in the country? Austin. And they literally went from, we got 25-year supply and not going to build anything forever, to number one real estate market in the country in 3 years. We get through these things is what I'm trying to say. One final example. The one thing people have tried to compare this to throughout this entire time is the Spanish flu. And everyone said that's the closest thing we have to this. And it is. It is the closest parallel we have. It's not a very good one for a variety of reasons. First of all, we were not a major world power in 1918. It was a much worse pandemic, at least from what we know thus far. I mean, 30 million people out of 100 million got it. I mean, 30% of the population got the virus. 600,000 of 100 million died. So, I mean, it was a much, third the size of the country and much larger impacts. But we were not a major world power then. The Federal Reserve was 5 years old. We had gone without a national bank from the time of Andrew Jackson up till 1913. And it didn't have any of the powers it has now for monetary policy. It got those in the 40s. So it was just kind of a fledgling organization. We didn't know the things we know about economic policy back then. Most of the great research on economic policy on the right and the left, if you want to get political about it, it all happened in the 1930s. And then if you think about it, there's a good reason why. A lot of economic research on policy happened in the 1930s. But we didn't have that in 1918. So it was a very, very different situation. It's really not comparable. The one thing I will point out, though, is despite the fact we didn't have monetary policy knowledge we have today and capabilities, despite the fact we didn't have fiscal capabilities, once we got through that, the next 10 years were one of the fastest growing decades in the history of the country that even today we call the Roaring 20s. I think we may be setting ourselves up for another Roaring 20s right now. Thanks.
All right, well, thank you, Dr. Perryman. That's really a great overview, and there's a lot of ground to cover here. And so we've got a few questions that have been coming in while you've been taking the world tour here, and we're going to get to a couple of those. And I'll just remind folks that are watching, if you do have a question, please chat it in, and we'll try to get to as many of them as we possibly can. So you talked about economic development and San Antonio, and we've had some successes this year.
Right.
And it's in a variety of different industries. We've seen distribution, we've seen high tech, We've seen advanced manufacturing. You remember back in the day when they thought when Kelly Air Force Base was going to close that we were going to shut the place down?
Right,
That's certainly gone a different direction. So what do you think, what advice or suggestions would you have to San Antonio to help San Antonio secure more business relocations?
Well, San Antonio has been doing quite well. I will say that. The other thing I will say is the competition is about to be more intense than it's ever been for new locations. And the reason is every city in this country, and frankly in the world, has been kicked in the teeth this year. So everybody's desperate for new activity. So the intensity of the competition is going to increase. But again, Texas has good incentive programs and that sort of thing available to use. And we've led the country in new locations for years and years. It's going to be the locally driven things, things like, and you have some good things going on here in this area. Inclusion matters. That's something that has been getting some people knocked off the list. And frankly, at the state level needs to do more. You've done well with that here. Inclusion is very important. Workforce development, education, and you're making investments in that, very important. And again, making this the place people want to be in a day-to-day life, and also if we have life in a year like 2020, will we continue to invest in broadband capabilities, continue to invest in your education systems, continue to invest in your health system, although again you have a world-class health system, but continue to do that, and so I would say the biggest thing is continue to get the word out because you have a lot to offer here. And the biomedical expansions are great. The advanced manufacturing, as you mentioned, I don't think most people realize until Kelly closed that San Antonio actually had a manufacturing base. It was called Kelly Air Force Base, and the data all put it over in the government side instead of the manufacturing side. But that's been turned into a great thing with Port San Antonio. Toyota was the beginnings of a real metamorphosis in education here in manufacturing here in San Antonio. So you've had a lot of things happening there, and continue to capitalize. We have a trade agreement in place now with Mexico again that's going to stay in place for a while. And although going through a lot of problems now, that's going to create some additional opportunities here. And so I think a lot of it's keep doing what you're doing. But I think as much as anything, I would say, really invest in the things that make the community a better, more livable place. It's already a very, very livable place. But invest in those things, and then get the word out. That's what I would say, because I think you have the tools to compete, but it's going to be very intense competition going forward.
Hey, we appreciate that very much, and it is great. I mean, you heard last week that San Antonio is on the short list for the Space Force,
Absolutely.
And I think that's a great segue from our military assets here. That could lead us to some great new opportunities.
That would be a great thing. As you know, the Army Futures Command went to Austin, and that's already creating a lot of synergies and that sort of thing. I think this thing, if we can beat out the folks in Colorado and maybe one or two other places and get that one here, that would be just great. And it's a perfect fit for San Antonio. So hopefully that can happen.
So one of the things you used to talk about in class was used to track U-Haul trucks and trailers coming from Chicago and New York and other places. Give us an update on the U-Haul, U-Haul tracker here, because there's a lot of California license plates showing up in Texas. Yeah, sure.
That's something in fact, I got a bum steer award from Texas Monthly for that one time. But sometimes look at strange things to try to see beyond the data and see what's going on in the economy. And U-Haul keeps fairly good records of where trailers are picked up, where they're dropped off, and if you go, if you are taking a trailer to an area that already has too many trailers, they charge you extra for that, and so they track it pretty carefully. So I would always watch the U-Haul thing to see what was going on and continue to. Frankly, this year migration is going to be down. I think it'll pick up again very soon because I think our opportunities are better here. But it had already been slowing a little bit because we had 11-year economic expansion. So not that many people had to move to get a job. When you had 3% unemployment across the country, 3.5%, that what you didn't need it. So people didn't have to move as much. So it slowed down a little bit already. This year is very slow, and I think a lot of things contributed to that. One was, obviously just the sheer disruption. People were looking for anything that brought them a little bit of sense of continuity and security. And then also moving would be a very difficult thing to do in this environment. I mean, it's just would be a very difficult thing to achieve with the social distancing requirements and that sort of thing. So it hasn't been as much this year as it's likely to be in the future. But going forward, I think we'll probably get 30 to 40% of our population growth in Texas will come from migration, as it has for the past 25 or 30 years.
So you see a lot of data every day, and you're trying to process all that. Give us a little insight into Ray Perryman's, brain here a little bit. What are the two or three measuring sticks that indicators that you're really paying attention to that helps focus, help you to judge how the economy is really doing, not just in Texas, but maybe across the country? What are the 2 or 3 sweet spot indicators that you're really looking at?
Well, I look at a number of things. Unfortunately, right now there's noise in a lot of the data because we're having to, local unemployment offices are having to process many, many more claims than they ever have before. We haven't kept the infrastructure in place to do that. Over the years, we've let it drift down. Some of them are still using fax machines, and all of a sudden, instead of processing 1,000 claims a month, they're processing 20,000 a week or something. I mean, it became very, very difficult to accomplish this in a lot of areas. So the data's been kind of murky and noisy this year. And I think you'll see some fairly major revisions. One area that's been noisy has been the initial claims for unemployment, and simply because the states haven't had the capacity to process them. That economists tend to want to give fancy names to things. If you break that down, initial claims for unemployment, for all practical purposes, is layoffs, because it's the first time somebody goes in and files a claim for unemployment. Well, the reason you do that is because you got laid off, and so it's basically a very good proxy for layoffs. And as I mentioned, it became very, very high. It sort of steadily went down from that 6.6 million down to about 1 million or so. Then it stabilized around between 700,000 and 800,000 for several weeks. It spiked back up recently. And I think what that's telling us is obviously the virus has spiked back up. And when you have the combination of the virus spiking back up, which has, means a few things have shut down, but it also means people are just more reluctant to do things. And then combine that with the lack of a stimulus package, I think we're seeing in those numbers is one thing I look at very carefully, primarily because it's a weekly number right now, and we need as much real-time information as we can get. And so that's one I've been following pretty closely through this time. I'm always looking at oil demand, not price. I mean, price is what it is, and I certainly look at it several times a day. But I really look at the demand for oil in the world. It was about 101 million barrels a day back before this started. It dropped down into the 70s. It's now back up into the 90s. So a lot of people said we've seen the peak in demand for oil. No, we haven't. I mean, we've already gotten back 2/3 plus of what we lost in terms of demand. But watching that get back up to that $100 million or 100 million barrel a day threshold, because that's when the industry really starts to make sense. And we've been seeing it gradually come up here the last few months. So that's one I watch a lot right now. Again, there's so much noise in the data. Employment data is a very good example. We're going to see massive revisions in these employment numbers down the road, because they're all based on surveys that sort of assume you have a certain number of establishments. Well, as we all know, a lot of establishments are no longer there. And consequently, the math doesn't always work right. And so when they resurvey, there's going to be some big adjustments in these unemployment numbers. And I think that's what things. So there's a lot of noise in the data right now. Those are the things I do. And the other thing I try to do, and admittedly, it's been tough this year, but it's something I do all the time. And those of you who've heard me speak or been around me before know this, is talk to people. I mean, I just try to talk to everybody that's out there in the world doing things, because I maintain the biggest modeling system in the world by a long shot. Hundreds of millions of equations, and we track all the data you can track. But it doesn't matter what the data says if that's not what somebody in the world tells you they're going to do. A model can predict there's going to be a real estate boom somewhere, but if there aren't any developers out there buying land, there's not going to be a real estate boom. So that I try to talk to people, and I even have systematic ways to factor that information into the models, because I think that's very important. And so I mean, those are the things I do. I mean, it's basically you all have the good fortune not to live in the world I live in, where you're immersed in the economic data all the time. And so it's kind of second nature to me to be looking at these things, but I'm always looking to get as much information as I can from out in the world, what's really going on.
Well, that's why we brought you here, so we didn't have to understand all that.
Have a cranial dump.
We just need the Cliff Note
Yeah.
version, but anyway, that's really helpful. So, hey, if nothing else, you all just got an insight into the brain of Ray Perryman today.
Bless your hearts.
What he wakes up thinking about every single morning. But hey, I want to remind people we're still good for a few more minutes, and if you have a question, please text it in, chat it in, and we'll try to get to it. I see another one just real quick. You talked a little bit about NAFTA
Yeah.
and the effect that might have on San Antonio,
Right.
especially post-COVID, and
Yeah,
what it might
right.
do for Mexico, despite their current health challenges. But
Right.
maybe dig into that a little bit more.
Sure, be happy to, and that's something I was involved in the first one and the second one. So I'm old enough to have been around a long time and gotten the pleasure of being involved in a lot of things. Honestly, the difference in the new one and the old one is not much. To tell you the truth, they're very similar. There are a few things that are better, a few things that are worse in the new one. Things that had to be done. There was a big emphasis in the administration insisted on a higher percentage of sourcing of parts for automotive, for example, in North America to be exempt from the tariffs. So that went up from 62.5% to 75%. That was not a particularly good thing. It sounds good until you peel the onion back. You say, oh, that means we make more parts here. What it really means is we pay more for the parts, and consequently our vehicles are less competitive. I mean, that's what it really means. But so I would have liked to see that, but it wasn't enough to hurt anything much. And we were able to modernize a lot of things. I mean, I mentioned smartphones earlier. 25 years ago, we didn't have smartphones. So much technology was not there. We really couldn't address energy in the first NAFTA. If you go back and think about it, we were coming off the energy crisis. We had an oil export ban on. Canada was just trying to get their tight sands formations going. Mexico was still had completely monopolized petroleum industry with no foreign investment. And basically, in the negotiations, it was just determined we just need to set energy to the side, because if we try to negotiate that, we're not going to get anywhere. So everybody do your own thing in energy. We'll make a deal about everything else. And that's what we did. This time around, you could address energy because we're now an exporter of energy. The world has changed there. Supply, demand conditions have changed. Mexico's having investment. Canada's had a lot of development. So, things have changed a lot. And so there, it's probably always a good idea to refresh things. We looked at the numbers, not surprisingly, that's what we do, and compared the USMCA to not having an agreement. Because if you remember, President Trump had already started the process to pull us out of NAFTA. So if we hadn't gotten a new agreement, it wasn't the new agreement versus NAFTA. The real trade-off was the new agreement versus no agreement. With no agreement, what happens is every country in the world that participates in international trade submits tariffs to the World Trade Organization. You can submit whatever you want to, but they all submit tariffs to the World Trade Organization. And then if you don't have a treaty with someone, that's what you use. I mean, that's the default tariffs. So I compare, what if we went to the default tariffs for all 600-something categories of goods? What if we went to the default tariffs versus what we'd have with USMCA? And what we found was the U.S. would lose about 600,000 jobs in foreign competition from that. 160,000 of those would be in Texas. Over a fourth of those jobs, because we are so integrated with the economy of Mexico. And obviously the southern part of Texas is the most integrated, and San Antonio is the first really major city you get to as you leave Mexico moving forward, and it has a lot of traditional cultural linkages with Mexico. There's a strong linkage between San Antonio and Mexico. So San Antonio is one of those that would have been particularly adversely impacted. So it's a very good thing. Again, we have to get past COVID to really allow it to work the way it should. We still need to invest in a lot of infrastructure along the border. Back in 2018, I spent about 6 weeks on the border, all the way from Tijuana and San Diego over to McAllen and Reynosa and that area. I mean, I was in all 10 border states and spent a great deal of time harmonizing all the data between the states and looking at things. And there's just an enormous amount of opportunity there. But we really need to invest in some infrastructure to make the process a more efficient process to move things back and forth.
Okay, well, that's really helpful. Hey, thank you so much for being here today.
My pleasure.
For giving us these insights. I mean, it's really, really, really helpful to us. And I really want to thank everybody for joining our call this morning. Again, I know, like you wish them all well and hope that they
Absolutely.
get through all this. And we will, absolutely, for sure. And just want to thank the North San Antonio Chamber of Commerce for all the great things they're doing. Sounds like you think that San Antonio has a bright future.
Oh, absolutely. I mean, it's a great city. There's a lot of things going for it. A lot of positive things have happened over the years. I mean, when I first started forecasting, San Antonio was a tourism town and a military town, basically, and to some extent a financial services town. You really expanded the financial services. The military remained strong, tourism remained strong, but you've added a manufacturing sector, because when Kelly closed and Toyota came in and all that happened, it turned itself into a significant manufacturing and now more technological manufacturing sector. Improved the workforce education opportunities greatly. Really took advantage of when NAFTA came into being, becoming a center for that expanded trade. When the Eagleford Shale was developed, becoming sort of the headquarters for the energy industry that was going to grow in South Texas. So there was just a lot of things have happened over the years. You've done a lot of things right in San Antonio, made some key investments at key times in things, and so I think San Antonio's always had a lot of promise and always had a lot of leadership that looked forward and tried to do things in a positive way. And I've had the privilege of being involved in projects down here throughout my career, and it's really been a great experience. And I've always enjoyed it because it is such a significant, exciting area that I think is really well positioned for what's going to be a very challenging future, but one with a lot of opportunities.
So we have done a lot of work on education, and I think when you're running around the country and running around, you talked about getting the word out.
Yeah.
I hope that you'll say really great things about San Antonio, because I think we are, sometimes the best kept secret maybe in the country. But you think about our workforce development, education.
Right, exactly.
We are really in a good spot right now.
Yeah, you really are. I mean, and education is so important. Those of you who have insomnia tonight, Google the Ides of Texas, IDES. It's an editorial I wrote in the Dallas Morning News a few months back about the importance of education to Texas and why we need to continue to invest in education in Texas. And San Antonio has really done a good job of that, and not at every level. I mean, your public school systems, your universities, everything has grown significantly. I mean, there was a point in time. I mean, I can go back and say one of the first economic development projects I worked on in Texas was MCC, the big think tank consortium that went to Austin. That really kind of kicked off the high-tech wave. Pike Powers, Mark White, and myself, there was a handful of us that were very actively involved in that. And at one point in time, when it was about the time that John Naismith had mentioned San Antonio and megatrends as a city of the future, San Antonio was on not the short list, but the fairly big list, I think top 16 or something like that. And at that point in time, it became very obvious San Antonio couldn't win that because you didn't have the workforce for it. If that same competition were taking place today, San Antonio would be in the thick of it because you do have the workforce to support it. I mean, a lot of things have changed. You do have the technology base here now. I mean, and those are things I've just seen because I've been doing this for so long. I mean, that was 40 years ago almost, 38 years ago, but I've seen all these changes take place over time. I don't think I've seen any city that's, went from essentially having a very little manufacturing to a significant manufacturing center, very little energy to a significant energy center. I mean, it's been an amazing transformation. Virtually no technology-oriented industry to speak of, to a major force in that. In the same time, beefing up the workforce. I mean, there's just been a lot of positive things that have happened over an extended period of time in San Antonio that speak very well to the city and to leadership over a long period of time. And I know you've been a leader in chamber activities, David. Many other people I've known when I first started working down here on things. Henry was mayor. I mean, so even before that, some, but Henry and Lila. I mean, there's been so many great leaders over the years that have put an imprint on this city, and that's continuing to happen now.
So we talked earlier about how we first met and in your class, and then you went on to develop the first econometric model in the state of Texas.
Yeah.
And I can still remember those stack of cards.
Yeah. Oh, man.
You actually put them in the computer.
I still have nightmares about
card
that.
reader sort of. I'm like, God, please don't let me drop this stack of cards. But so you've made lots of advances in terms of technology and the way that you're just modeling things these days. what changes have you made in terms of the way your process and how you are building your models, and maybe even some of the key assumptions that have changed over the years that people might be interested in hearing?
Well, I mean, literally, when I started doing this, I mean, as David said, and he was around for that, you use card readers, you use dot matrix printers that ran at 300 baud. No K, no M, no G, no T, baud. Okay, and I mean, it was a very, very different world, and you got your output back from the computer on a printer. So if there's something wrong with it, you just had to start over and do it again. I mean, it was a very, very cumbersome process. Obviously, the technology's changed a lot, and at that point in time, I had some relationships and ability to work on what was at that time the largest, literally two computers linked together. Back then, that meant there was a 30-mile wire in Houston linking them together. And what I could do on that computer then, I can do on a laptop today, and many times that amount. So there's been great advances in technology. Texas has changed so much. I mean, I've been doing this again since the early 70s, and the late 70s. And back then, I mean, literally, you could plot the rig count, and you could plot the gross domestic product of Texas, and they pretty much laid on top of each other. I mean, if you scale them right. I mean, Texas was an oil and gas state. It's still a very important part of our economy, obviously, but we've seen the technology industry develop. We've seen our global trade develop. We've seen so many things emerge in Texas, and we've been fortunate enough to do quite well with it. So it's been fun to grow that part of it, and also, of course, over time I've been able to expand it out to all 50 states and all countries all over the world, and that's been an interesting process for me. It's given me a lot of opportunity to observe things. But as far as the assumptions and that sort of thing, I think the biggest thing is back then, I mean, the first thing I would do is check the price of oil, check the rig count. Those drove everything. And one of those indicators I used to joke about back in the 80s during the bust, kind of like the U-Haul index, was what I call the shiny rig index. And what that was, I'd be driving around Texas, and back then most of the rigs were just literally laid over in a field somewhere rusting out. And if you saw somebody sandblasting a rig, or you saw a rig that had recently been sandblasted, that was a good sign. That was a leading indicator, because you knew something was about to happen to that rig, because they didn't bother unless they were going to use it for something. So I mean, the world has changed so much during that time. There's been so many advances in technology. It's been a fun ride for me, and it's been a good thing that's happened. And so I've always it's been a real pleasure for me to get to do this, but it has evolved amazingly, and the technology that's available now is and the ability to use data systems and that sort of thing and crunch many more numbers much more efficiently has been really good. Again, if you have the weird brain and weird lifestyle that I have, it's not good for your social life, but otherwise it's been very rewarding, very enjoyable.
Thank you. Hey, so I'm a banker, so I got to ask you a question about debt.
Okay, sure,
All
of
right.
course. Yeah.
We've been racking up we've been printing money around here in this country.
Yes.
We got a lot of debt and national debt. So how much is too much, and how close are we getting to the edge here?
A very good question, and I feel almost schizophrenic answering this question, because those of you who've heard me over the years know I have railed about the inefficiency of government and the need to bring the debt and deficits under control for years and years and years. And right now, I think we need to take on more debt. And the difficulty we face is, the numbers in the 20 trillion range. We've added significantly to it this year, obviously, but we're nowhere close to that magic number you're talking about. What is the number where nobody will hold our debt and we can't sustain it? It's probably 4, 5, 6 times. We tried to model it, and best we can tell what it is today. I mean, we're nowhere close to that. And the reason is very simple. In times of uncertainty, and we've certainly seen that everywhere, people want safety. And to this day, the world's definition of a politically risk-free asset is a U.S. government security. Whenever you're setting a discount rate at your bank or an interest rate, and you're trying to figure out what you start with the government bond rate of that maturity. That's the risk. That's the definition of risk-free. Then you add to it based on the risk. I mean, we are the world's definition of that. And there's many examples of that. Back in the 2008 crisis, I mean, that was the mortgage crisis. We caused it. We were the ones that had the big mortgage bubble. It created a global recession. We basically said to the world, we're going to put $1 trillion out there this week. Okay? Our interest rate went down because people wanted to hold U.S. debt in times of uncertainty. Now you're a banker, and I don't hold that against you. And so let me put it to you this way, and I know we have some other bankers on the line today. What if I walked in your bank and you were mad at me? You know, again, we created it, so the world was mad at us about it. Suppose I walked into your bank and I said, David, here's the deal. I already have way too much debt. Have absolutely no collateral. I know you're mad at me, really mad at me. I need to borrow more money than I've ever borrowed before. What do you say? I mean, I think the obvious answer is no, right? The world didn't say no. The world said, not only will we lend it to you, we'll cut your rate because we want it. And all that to say, as we are a very stable thing, and we've seen a recent example of that. I mean, we have peaceful exchanges of power. This has been, there's headlines every day now about, will the president concede, will he not concede, that sort of thing. Nobody doubts that on January the 20th, a new president is going to take the oath of office and be the president. Back in 2000, we had the big dust up between Bush and Gore in Florida. Everybody knew that's what we do. We would end up having a peaceful transfer of power. That's what we do in this country, and that's somewhat remarkable statement if you think about the world and all the changes in power that take place, and sometimes not so peaceful. I've always marveled at Latin America. As you know, there's a lot of revolutions in South America, a lot of revolutions, a lot of governments overthrown in Central and South America. There has never been a revolution down there during baseball season. They have their priorities straight. First, they settle the pennant race, then they overthrow the government. The priorities are very well defined there. But the bottom line being, the world is becoming more uncertain over time. And as David knows, as a former student, I could now launch into the second law of thermodynamics and talk for an hour, but I won't. About why that's happening and why that's likely to happen even more in the future. But in any case, in an uncertain world, people want U.S. currency. So we're okay from that standpoint. Having said that, and I know we're running short on time, having said that, we've run up too much debt, and we need to get it under control on a long-term basis. Look at the Social Security systems and things, but not from the standpoint of people who are retiring now. My kids, my grandkids. You can revamp these systems and save trillions of dollars over time and make the system stronger and better for them. I mean, there's things we need to do and look at and be realistic. Unfortunately, they require bipartisan cooperation, and they require a vision beyond the next election, and those are two tough things to do. As far as today is concerned, I'll make it very quick. A very good economist who was one of those people in the 30s who gave us all some new ideas that we've used a lot in the past year, John Maynard Keynes. Somebody pointed out to him once, and he was saying what government could do to help us get through something like this. He said, well, sir, in the long run, markets will solve all this. And his response was, that's true. In the long run, we're all dead. Right now, we're in a critical situation. We need a government response to that situation. Beyond that, in more prosperous times, we need to get together and get deficits under control.
Great. That's really helpful. Hey, thank you for what you've shared with us this morning. We always appreciate the fact that you love San Antonio and you're always here to help us. I want to thank everybody for their great questions this morning. And with this, I'm going to turn it back over to Christina for maybe a couple of closing remarks. But before we do that, we're not together, so I'm just going to go ahead and do what everybody would do if they were. And
Thank you very much. I appreciate
Great job.
that.
Okay.
That concludes our event for this morning, and thank you everybody for joining us. You should have in your email boxes Dr. Perryman's data that he normally would have shared with us if you were sitting at a luncheon with us. And you can also find it on our website this afternoon. Thank you to David McGee, Amegy Bank as our title sponsors once again, and thank you to the rest of our sponsors for always supporting us with this event. We have lots of exciting new events and new things coming up for 2021, so stay tuned for that. And I want to wish everybody a Merry Christmas, Happy Holidays, stay safe, and please, please, please wear your masks. And have a great day, everybody.